Welcome to this weekly update. I'm Julia Lee, an equity strategist at Bell Direct. And this week, it's all going to be about the US interest rate level. Will the Federal Reserve cut interest rates by 25 basis points or 50 basis points? And that's going to be the key driver of return expectations for global share markets and assets. So given it's a big event, let's start off with strategy and having a look at JP Morgan, where they've done a piece on the opportunities in the market. They say that there's an unprecedented divergence between various segments of the market, and this offers a once-in-a-decade opportunity to position for convergence. They're seeing record divergence between value and cyclical on one side and low volatility and defensive on the other side. The level of divergence is much more significant, they say, than when compared to the dot-com bubble valuations of the late 1990s. They see a bubble of low volatility stocks versus value, and that's more significant than anything that the share market has seen in recent history. They say a rotation would push significantly higher all laggards, such as small caps, oil and gas, materials, and more broadly stocks with low PE ratios and price to book ratios. Having a look at Morgan's, which has been looking at the banks, they say their base case remains one of no nominal dividend cuts, which is great news for income investors. They say that the stimulus initiatives are serving to de-risk the outlook for the banking space. Westpac remains their preferred major bank. They say that Westpac is generating the highest return on tangible equity of the major banks alongside Commonwealth Bank, but is trading at a 25% discount to Commonwealth Bank in terms of price to net tangible asset multiples. They've also upgraded ANZ to add, which was previously a hold. Staying in the financial space, and Citi looking at diversified financials, but unfortunately not too optimistic. They say that diversified financials are a tough space right now, and their analyst Nigel Pittaway has zero buys in the sector. His pecking order amongst the neutrals are Janus Henderson, Computershare, Challenger, Link, as well as Perpetual. He keeps the sell calls on the ASX and IOOF, and on IOOF, he's calling for a possible rebasing, with the company likely to provide clarity on the costs involved in the seemingly necessary restructure of the advice unit and, of course, the higher remediation costs. Morgan's having a look at listed investment companies, and of course some of these trade at a premium and some at a discount. So let's have a look at the ones trading at a premium. Wilson Asset Management has seen large premiums, and that's reflective of the strong investor interaction with the manager. Outside of Wilson Asset Management, though, we are seeing high yielding funds which are performing well, also trading at a premium. On the flip side, if we have a look at listed investment companies at a discount, listed investment companies should really reflect the underlying assets, but many do trade at a substantial discount of around about 20%. The largest discounts are mostly due to small market caps and an illiquidity discount. The pros, I guess, in getting an LIC with a discount is that you could be getting a bargain. The con is that it could be difficult to exit or reflective of a lack of confidence in that investment manager. Looking at different sectors now. And let's have a look at UBS, which is looking at the auto retailers who have done it tough over the last few years. They estimate that a 10% rise in house prices should see total new car sales rise by around about 8% over the next 2 years. They say that new prestige and luxury cars would rise by around about 10% over that time. Their base case is that we see car sales growth from June 2020, that quarter, and their base case is that we see house prices bottoming out in the December quarter this year. They forecast a new volume car decline of 5% in this calendar year, but a 1% recovery in 2020. Staying with sectors, and this time then looking at health, and they say amongst high growth offshore earners, they see earnings per share moving higher for ResMed and Cochlear, but moving lower for CSL. The valuations for Sonic and Ansell are now full, but they still remain overweight on a relative basis. They do, though, see negative earnings per share revisions for Ramsay Health Care, and that's why they retain an underweight position there. So all in all, it's going to be a big week for markets. The Aussie share markets should all now be back from school holidays. And of course, that interest rate meeting in the US will dictate asset returns all over the globe. I'm Julia Lee, an equity strategist at Bell Direct. Hope to see you next week.